In the complex world of semiconductors, there are companies that build factories, and there are companies that build ideas. While giants like TSMC spend billions on machinery, there's a class of companies that operate with pure intellect. They design the blueprints, the invisible architecture that makes our devices work. Today, we are going to talk about one of the most critical, yet under-the-radar players in this space. A company whose technology is likely in your pocket right now. That company is CEVA, ticker symbol CEVA. We have analyzed their financial journey from the height of the 5G boom in 2021, through the painful inventory correction of 2023, and finally, to the recovery signals emerging in their latest Q3 2025 report. This is a story about the transition from simple connectivity to smart edge AI, and what the financial data tells us about their future. Let's start with the business model because it is crucial for understanding the numbers. CEVA creates intellectual property, or IP. They design the digital signal processors and AI engines that handle Bluetooth, Wi-Fi, 5G, and audio sensing. They don't manufacture chips. Instead, they license their designs to chip makers. This gives them two revenue streams. First, licensing fees. This is the upfront money they get when a customer decides to use their technology. It represents R&D activity in the industry. Second, royalties. This is the recurring income they earn every time a device containing their IP is sold. Licensing is the seed. Royalties are the harvest. Let's rewind to 2021 and 2022. The world was hungry for connectivity. 5G handsets were exploding and Bluetooth devices were everywhere. CEVA's revenue hit record highs. In 2022, total revenue reached over $134 million. The royalty engine was firing on all cylinders as consumer electronics flew off the shelves. The stock price reflected this optimism. But then the music stopped. In 2023, the semiconductor industry hit a wall. High inflation and economic uncertainty caused consumers to stop buying new phones and gadgets. Manufacturers found themselves sitting on mountains of unsold chips. This is called an inventory correction. For a royalty-based business like CEVA, this is painful. Even if their technology is essential, if no new devices are being shipped, the royalty checks shrink. In 2023, their revenue dropped to roughly $97 million. They went from operating profits to operating losses. The market punished the stock, questioning if the growth story was over. However, smart investors know that semiconductor cycles are just that, cycles. They go down, but they also come up. And the 2024 and 2025 filings show us that the bottom is likely behind us. Let's look at the data from 2025. We have the Q1, Q2, and Q3 2025 10Q reports in front of us. The narrative has shifted. The inventory glut in the consumer and mobile markets has largely cleared. In the third quarter of 2025, CEVA reported revenues that signal a return to stability. But more importantly, the mix of revenue is changing. The company is pivoting. They are no longer just a mobile phone story. They are aggressively targeting the smart edge. What does this mean? It means putting AI directly into devices, earbuds, watches, smart home cameras, and cars, without relying on the cloud. Their NeuPro-M NPU IP is a prime example. This is a processor designed specifically for generative AI on edge devices. As AI models get smaller and more efficient, the demand for on-device processing power skyrockets. CEVA is positioning itself to be the standard architecture for this trend. Let's analyze the financials in late 2025. Gross margins remain the company's superpower. Because they sell IP and software, their cost of goods sold is incredibly low. In Q3 2025, their non-GAAP gross margin hovered around the high 80 to 90% range. This is elite. It means that, as revenue recovers, the profit drop through to the bottom line will be massive. This is called operating leverage. We also see disciplined cost management. During the downturn of 2023 and 2024, management trimmed operating expenses. Now, as top-line revenue starts to grow again in 2025, those lower costs mean they can return to profitability faster than in previous cycles. Another bright spot is Bluetooth. CEVA has an incredibly dominant market share in Bluetooth IP. If you own wireless earbuds or a smartwatch, there is a very high probability it runs on CEVA's IP. The 2025 reports indicate continued strength here, driven by the new BLU-ETO OTHLE audio standard, which improves sound quality and battery life. However, no investment is without risk. The 10-K filings highlight significant exposure to China. A large portion of their royalty revenue comes from Chinese handset makers. Geopolitical tensions or a slowdown in the Chinese economy remain a key risk factor that investors must monitor. Additionally, the recovery in the base station 5G market has been slower than anticipated, acting as a slight drag on growth. So what is the verdict? CEVA has weathered the storm. The inventory correction of 2023 washed out the weak hands. The company has used this time to refocus its R&D on the next big wave, Edge AI and automotive. The 2025 data suggests that the royalty engine is restarting. Licensing deals are picking up, which is a leading indicator of future growth. For investors, the thesis is simple. If you believe that the number of connected smart devices in the world will continue to grow, and if you believe that AI will move from the data center to the device in your pocket, CEVA is a pure play bet on that future. They provide the intellectual building blocks for the AI-enabled world. The cycle has turned. The question is no longer if they will recover, but how high the next peak will be.